Good evening, Deepak. Lakshman and welcome. Krishna Raj, welcome Karna. Danush Priyam, Kavita Arti, good evening. Yes, Hariharan, welcome. Shruti, welcome ma. Sendil Kumar, good evening. Satish Kumar, good evening. Pavitra ji, welcome. Raghu, welcome. Raj Ganesh, Vishu, welcome Karna. Swami Ashogan, good evening. Vikash, good evening. Shankar Ram, welcome. Now, so very good evening to all of you, my dear students. Welcome to Premier Academy webinar series. Today, income from house property, the key aspects which is applicable for November examination, because July exam merged with November examination. What are all the key aspects, where and all case study based questions are there, or how to approach the same, those to explain those things. I would like to invite our Premier Academy alumni, my proud student, CA TV Muthu Abirami. Welcome, Abirami.
Thank you, sir.
He's a chartered accountant. If you want to read her profile, the half an hour session will go by way of reading her profile itself. So I'll cut short and tell. She's a chartered accountant. She has completed chartered accountant. Thereafter, she finished BA BL, specialized in business law. Now she is a practicing advocate in Chennai. School of Excellence in Chennai, she has completed the law. She has completed diploma in international taxation from ICAI course. Appeared before various appellate tribunal. The chairperson for Direct Taxation Committee, Resource Committee. Faculty for law also. She is taking law classes for Dr. Ambedkar Law University. She has presented various paper presentation in various seminars. Sikasa committee member also. When she was student itself, that time she used to conduct many programs. I also participated as a technical person, chairperson. By that time she was working as a student, Sikasa student, Sikasa chairperson, my chairman. So, and she won various awards by way of presenting the paper. Is a good speaker. Welcome, Muthu Abirami. Over to you. Now, kindly address the student. July exam merged with the November examination. So, what are the key aspects with respect to house property? What are the post exam trends and all? Kindly explain the concept behind house property and the key aspects of house property. Thank you, Sana. Welcome.
Sure, sir. Thank you. Thank you for the introduction, sir, and good evening to one and all present here, all the students and others. Today, we are going to deal with the important aspects of computation of income from house property. I will take you through the various provisions concerning this head of income, and thereafter, I'm sure it is going to be very easy for you to understand and approach the questions for your exams. Now, if you take the income from house property, this starts from section 22 to section 27. Section 22 is the charging section. It's a charging section. So basically, if you take income from house property, our common understanding is that income from house property means rental income which we are receiving from house property. But as far as the Act is concerned, the Act deals with the annual value of a house property, not exactly the rental income, but the annual value. So this chargeability about the annual value is dealt in section 22. Section 23 deals with how to determine this annual value in various circumstances. Whether the property is let out, whether the property, even when it is occupied by the person himself, self-occupied property, under various circumstances, section 23 deals with the determination of annual value. Section 24 deals with the various deductions which we can avail under this head. Section 25 deals with inadmissible deduction. It's one section on inadmissible deduction. Then section 26 deals with when the property is owned by co-owners, how to determine the value when the property is owned by the co-owners. And section 27 deals with certain definitions concerning the computation portion, which we will be dealing. So now section 22, as I mentioned, it is a charging section. It states that the annual value of any property comprising of buildings or land appurtenant thereto, of which the assessee is the owner, is chargeable to tax under the head income from house property. So we will dissect the section now. Section 22, we are going to dissect and understand the various terms used in section in this particular section. Now, section 22 as chargeability. So it lays down the conditions for chargeability. That is what we dealt now. So first of all, the first condition is that the property should consist of building or land appurtenant thereto. So the important feature is that there should be a building. There should be a building for chargeability. So this building not only deals with residential buildings, but also factory buildings, commercial buildings, shops, godowns, etc. Then what is this land appurtenant thereto? Land appurtenant thereto means land connected with the building, like garden, garage, etc. And now, having mentioned that building is an important aspect for chargeability, I'm going to put you a question. There is a vacant land. A person is earning rental income by letting out this vacant land. It's a plain vacant land, nothing else. Whether chargeability under section 22 will be attracted in case of this vacant land? This is my question. Think over for a minute in the context of what I said some time back. Building. Building is an essential condition for chargeability. So, if the person is going to let out only a vacant land and receive rental income for that, the said income would not be charged under income from house property. So, if you are letting out a vacant land and receiving rental income, it won't be charged under the head income from house property. Rather, it will be charged either under other sources or under profits and gains of business or profession, as the case may be. Why as the case may be? Suppose this person has the intention of doing business by letting out this vacant land and receiving rental income. Then, if his intention is commercially exploiting the property by carrying out business, then it will be charged under the head business or profession. Otherwise, it will be charged under the head other sources. So this is the key feature. So first feature for chargeability is that the property should consist of building or land appurtenant thereto. Now, I would also like to put you a question, which is a decided case law. Yes. We might have seen instances where you let out your terrace portion for mobile towers. You will give that space in your terrace. You will give that space in your terrace for hosting mobile towers or even for hoarding advertisements. So whether this will be charged under the head house property or not. This is the question. Now think over for a minute and I will let you know the answer. If you take up this space which is given for holding commercials or for keeping mobile towers, it will be considered as income from house property. So there are decided cases which hold that income which you receive from letting out the terrace for hosting mobile towers, mobile phone towers or hoarding or advertisement, it is taxable as income from house property. First case. Second decided case that I would like to highlight is on one aspect. This is a very old case. There is a building. Adjacent to the building, you have some land, and that is, it all forms part of one single property, land and building, apartment, that something you can imagine that it is land and building in the center. It's a big land, and in the center you have a building, and in that land portion, that is in the portion adjacent to the building, the owner of the property allows third parties to draw well water, and this assessee, he claimed electricity charges, other maintenance charges, etc., and wanted to show this income from letting out the space pertaining to well water, like for drawing the water. He claimed it under the head business. He didn't want to claim it under house property. But the income tax department sought to levy tax in respect of this income under the head house property. The court held that no doubt you can tell that it is a land adjacent to the building, but this source of income, that is drawing water from the well in the connected portion of the land, it is a separate source of income by itself. It is not connected with the house property. So the court held that you need not claim it under house property. It is okay if you claim it under business or profession, because it becomes a separate source of income for the assessee. The court gave an example by holding that, suppose there is some mineral under the in that particular land. If you excavate and take that mineral, in such situation, it becomes a separate source of income. So it has no connection with that building, and therefore it need not be taxed under the head income from house property. So the point I'm trying to impress upon here is that when it comes to chargeability, the property should consist of building or land appertaining thereto, and this building can be residential or commercial building. At the same time, remember that vacant land, rent received from vacant land will not be taxed under the head income from house property. Now, second aspect concerning this chargeability, assessee must be the owner of the property. So, ownership. So, normally when you think of ownership, what is that you can think about it? You will think that sale deed will be in your name, right? You have a sale deed in your name, you do a proper registration from the sub-register office and own the property in your own name, in your own title, with the proper documentation. This is one way of looking at ownership under this provision. Apart from that, the court has held that owner is the person who is entitled to receive income from the property in his own right. In his own right, the assessee should be able to receive the income. That is sufficient to call the person as an owner. He need not be the title document holder to be called as an owner. That is the first aspect. So therefore, it brings us to the second aspect. Requirement of registration of the sale deed is not necessary. Okay? For the person to be called as an owner, he need not be the owner by way of holding a title deed in his favor. Thirdly, ownership includes both freehold land and leasehold land. Freehold land means you are holding it in your own right. You can enjoy it fully, no matter what, and you have a full power and power to enjoy the property. Leasehold right, as the name suggests, is when the property is given to you on lease, on a rental basis, on a lease. That is leasehold right. So, ownership includes both freehold and leasehold rights. Next is ownership includes deemed ownership. What is this deemed ownership? This deemed ownership is dealt in the Act itself in section 27. Okay, deemed ownership. I will take you through the concept of deemed ownership now. First, first of all, you all understand what is meant by deemed ownership, right? In the sense, you are not actually the owner, but the law will state that you are the owner, even though you are not actually the owner. Deemed ownership means, though you are not actually the owner of the property, still the law will say that you are the owner, even though you are not actually the owner of the property. So that is deemed ownership. Okay. Now, what are the instances of deemed ownership as delineated under section 27? Let us look into it. First is transfer to your spouse, otherwise than for adequate consideration. Without adequate consideration, if you transfer the property to your spouse, okay, A is transferring the property to his spouse B without adequate consideration, then ownership is deemed to lie only with A, the husband, okay, not B. Even though the property is transferred to B, still the law deems that the owner is only A, the husband. Okay, first condition. There is an exception to this condition. What is the exception? If the spouse, if the husband and wife decide to live apart, maybe they are divorced or maybe they agree to live apart, in that case, if the husband or the spouse, as the case may be, it can be vice versa. The wife can transfer the property to the husband, or the husband can transfer the property to wife. It can be vice versa. So when they have an agreement to live apart, in that case, if if the spouse is going to transfer the property, the person is going to transfer the property to his spouse, then the ownership will be with that spouse only. Okay, so the basic condition is, in a normal scenario, when a husband is transferring the property to the wife, or the wife is transferring the property to the husband without adequate consideration, okay, the transferor will be the owner. Exception is when the parties decide to live apart. When they decide to live apart, when they are no longer intending to live together, when they no longer want to live together and they decide to live apart, at that particular time, if the person is going to transfer the property to the spouse, then the owner will be the transferee to whom the property is being given. The transferee will be the owner. Got it? So this is the first case. Second case is transfer to a minor child. Similar to spouse, if the person is going to transfer the property to his or her minor child, then the owner is deemed to be the transferor is deemed to be the owner. Okay, suppose the father is going to transfer the property to his minor son who's only 10 years old. It is transferred. Now, who is the owner? The father will be the owner. The father is deemed to be the owner. Though the property is transferred to the son, minor son, still the father is deemed to be the owner. Again, this has an exception. What is the exception? When the property is transferred to minor married daughter. Minor married daughter. So the father is going to transfer a property to his minor daughter who is married. She's only 17 years old, and if she's going to be married, and the father is going to transfer the property in favor of this minor married girl, then who will be the owner? The owner will be the minor married daughter. So normally speaking, the law deems that the owner will be the parent when the property is transferred to the minor child. Exception is when the property is transferred by the parent to the minor married daughter. This is an exception. Okay. What is the basic reason when why exception is given to minor married daughter is that it acts as a security to that minor married daughter. The property might act as a security to minor married daughter. So for that reason, the law still keeps this particular transfer alone apart from the deemed ownership concept. I also want to tell you one more thing. We saw that transfer to the spouse without adequate consideration, right? Now, this is the concept that I want you to also link with your contract law, which you studied in your CBT, in your basics. Consideration. Love and affection is also consideration. Normally, when a husband is transferring the property to the wife or wife is transferring the property to the husband, how it will be transferred? It may be transferred by way of a gift deed, or it may be transferred by way of a settlement deed. In this case, invariably, the documents will be written stating that out of natural love and affection, I am transferring this property to my wife, to my husband, as the case may be. So, natural love and affection constitutes consideration, but natural love and affection does not constitute adequate consideration. That is what the law intended to mean here. Suppose the husband is transferring the property to the wife at the market value itself. The property costs 1 crore rupees. The husband is transferring the property to the wife, and the wife is paying 1 crore rupees to the husband. In this case, who is the owner? The owner is the wife only, because she has paid 1 crore rupees, adequate consideration, the market value, and purchased the property. Therefore, there is no deemed ownership in this case. It will be the wife who will be treated as the owner. When the property is transferred without adequate consideration, then the owner will be the person who is transferring the property, the husband, as the case may be. Okay, this is the second. Third deemed ownership is with respect to holder of an impartable estate. Impartable estate means a property which is not legally divisible. It is not legally divisible. This impartable estate concept, if you look at it, it was there before Hindu Succession Act was amended. Before the enactment of Hindu Succession Act, at that point of time, there are some customs by way of customary practices. The eldermost person in the family will inherit the property, and the property cannot be divided among other members of the family. Some customary rights were there. So that was abolished after Hindu Succession Act. That is one thing. Second thing is that sometimes the property might be given by way of a grant, government grant, like a covenant given to a party. Mostly in these cases, it will be the erstwhile rulers, zamindars, raj, these people. If the property is given as a grant, then these will be treated as impartable estate. So after Hindu Succession Act, if a property consists of impartable estate, it will be dealt as a HUF. It will be assessed in the status of a HUF. So normally, deemed ownership, when you look into the concept of deemed ownership, holder of an impartable estate would also be deemed to be the owner of the property. Next is member of a cooperative society. In some states of India, the house building scheme is normally owned by a company, a cooperative society, or an association, and they will allot individual flats and units to the members of the society. In this case, even though the ownership lies with the cooperative society or the company or the association, still the owner is deemed, still the person who is allotted the property is deemed to be the owner. Okay, the society will give allotment to individuals or to various parties who will use the building, who will be the allottees of the building. These allottees are held to be the owner as per section 27 deemed ownership. Okay, this is one aspect. Next is person in possession of a property with respect to section 53A of Transfer of Property Act. Okay, this 53A of Transfer of Property Act is a peculiar case where the ingredients in 53A are there with the buyer. The sale consideration may be paid or even promised to be paid to the seller. Suppose I am the buyer, I am possessing the property, that is, I am using it, I have every right in the property, I started using it, I am possessing the property. I have not yet paid the consideration, I have promised that I will pay the consideration. Or I might have paid the consideration altogether and start using the property in my own right as a possessor. But sale deed might not have been entered between me and the seller. and the buyer shows, I might not have entered into a sale deed with the buyer, but other documents like power of attorney or agreement to sale, all these things have been executed. Maybe take a case where where the seller has agreed to sell the property to me. I've taken possession of the property. I've also paid a part of the consideration. Balance I am promising to pay later. Okay. In this case, even though the title is not with me, even though there is no registered title in my favor, still I will be construed as the owner because I am a deemed owner as per this section. Excuse me.
Muthu Abirami,
Sir, yes, sir.
vacant land or land used for car parking or tower which is there in the what
Yes,
or
sir.
holdings, this and all will not come into the income from other sources. I hope it form part of income from other sources. It won't
Sir,
become your house property.
there are judgments which say that the terrace is not a separate land. Terrace
Okay.
forms part of the building, therefore it is house property. So some judgments say that mobile towers, when you're installing in terrace, it will be house property. But exclusive car parking or the exclusive garage, like you said, those will be assessed under the head other sources or business or profession, as the case may be. Suppose I have 5 places in Chennai, 5 open spaces where I can allow people to park their cars and vehicles. Then my entire operation, my entire business activity is only letting of these places and getting rental income from them. In these cases, it will be treated as business or profession. So there, it depends on the intention, how they want to commercially exploit the property. So we have many Supreme Court judgments on these lines, sir.
Okay, thank you.
Yes, sir.
Carry on. Yes.
Yes, sir. So we dealt with section 53A of Transfer of Property Act. This is with respect to part performance of contract. So part performance of contract, 3 conditions we saw. If these 3 conditions are satisfied, then the person will be deemed to be the owner, even though sale deed is not executed in favor of the buyer. Okay. Next important feature with respect to deemed ownership is that where the person has a right in the property for more than 12 years or more. For 12 years or more, if I have a right in the property, then again I am deemed as the owner of the property. When this can happen, a lease, where the terms of lease hold that the lessee can hold the property for 15 years, 99 years lease. There are many cases which you might have come across where the property is let out for 99 years of lease. In these cases, one cannot say that I am only a lessee. I am not holding the property in my name as a title holder, so I am not the owner. You cannot take such plea. So once the person is holding the property for more than 12 years in his own right, then in such cases he will be the deemed owner. But again, there is an exception to it. When the property is dealt with, if it is leased out on a month-on-month basis, every month the lease is renewed. In that case, even though he has been holding it for a very long time, more than 12 years or 15 years as the case may be, still you cannot be termed as the owner of the property. Number 1. Number 2, where the rental agreement is within a period of 1 year, 11 months rental agreement, classic cases we might have seen where the rental agreement is for a period of 11 months. In those cases also, the person will not be termed as an owner. Now, Tamil Nadu Rent Control Act has been amended. Now, even if you're going to have a rental agreement for 3 months or even 1 month also, you're supposed to register it. Previously, we all know that more than 11 months only you need to register. Now it has been amended. So, whatever be the duration, you have to register the agreement. So, when there is this kind of arrangement where every month the tenure, you have an agreement for every month or for a period not less than 12 months if you have an arrangement, if you have an agreement, in those cases, the lessee will not be termed as the owner. There will be cases where the property is let out for a period of say 6 years. And then in that term itself, in that agreement itself, there could be a term where the property can be let out for a further period of another 6 years or as the case may be. If such term is there also, even in those cases, it will be the lessee who will be termed as the owner, provided the property has been held for a period of more than 12 years. So we saw the concept of deemed ownership. A quick recap on deemed ownership is transfer to spouse, exception when they are going to live apart, transfer to minor child, exception minor married daughter, holder of an impartible estate, member of a cooperative society who is holding the flat as an allotee. He will be the owner, not the society. Then Transfer of Property Act, Section 53A, possession passed on, part consideration paid, but sale deed alone not executed, but other documents have been transferred, like power of attorney or sale agreement has been entered into by the parties. Then also it will be the person, the buyer will be termed as the owner. Then person having a right in the property for a period of 12 years or more. In these cases, even though it is only a lease agreement, still the lessee will be termed as the owner. So this is the concept of deemed ownership. So why did we go to the deemed ownership? Because we were dealing with chargeability under section 22, and one of the features is that the assessee must be the owner. So when I have been dealing with owner, I stated that owner is the person who is entitled to receive the income in his own right, not necessarily as a legal title holder, but in his own right, as the case may be. In that case, we dealt about deemed ownership. So next concept is that it's a very interesting concept pertaining to chargeability section. A person could be the owner of the land. A person could be the owner of the land. I am the owner of the land. I am allowing some other person to construct a building on my land. Okay, Mr. X is coming and constructing a building on my land. In this case, Mr. X will be deemed as the owner in respect of the building, and income from house property will be charged if other conditions are satisfied. So, a person need not be the owner of the land also. It is sufficient if he is the owner of the building for him to be charged under this, for the property to be charged under this head. This is another aspect. Another aspect is that the assessee must be the owner in the previous year in which the income is sought to be taxed. He need not be the owner in the assessment year. Take a case, 1920 is the previous year. Okay, 1st April 2019 to 31st March 2020 is the previous year. This is the year you want to tax the income. The property is sold in April 2020. Okay, even before filing the return. Assume for a moment that July is the last date. Of course, July is not the last date because for this year extension has been given. Suppose July is the last date. In April itself, the property has been sold. He is even yet to file the return. Can the assessee state that I am not the owner of the property while filing the return, so I will not show income from house property in respect of the property that was sold? No, he cannot state like that. So for the previous year, he should have been the owner. For the assessment year, whether he is owner or not doesn't matter. That is a point I wanted to state. Then similarly, where the person recovers unrealized rent, we will deal with that. When he is receiving the unrealized rent, the period in which he is receiving the unrealized rent, at that point of time, in that period when he is receiving the unrealized rent, even if he is not the owner of the property, still it will be taxed. Say for example, I am receiving a rent pertaining to 2010, whereas I sold the property in April 2020 itself, but the unrealized rent of 2010 is coming to me now. Can I say that no, I am not an owner? No. In 2010, if I were the owner and if that property belonged to me, if other conditions are satisfied, then this income will be, this unrealized rent will be taxable in my hands. I cannot claim that I am not the owner at this point of time when I am receiving the unrealized rent. Next is use of the property. This is a very, very important aspect you need to understand. If the assessee is using the property for his own profession or business, the property or a part of the property, the assessee is going to use it for his own business or profession, then it will not be, the property will not be taxed under the head income from house property. Under this head, the property will not be taxed. Number one. Number two, when the assessee is engaged in the business of letting out of properties on rent, then it will be taxed as business income, not under this head. I'm the owner of many properties. Take an example that I'm an owner of about 10-15 properties. My intention is to commercially exploit and to do business. This is my business. This is probably even my only income. In this case, this income will not be treated as an income from house property. Rather, it will be treated as an income from business or profession. Similarly, I'm an advocate. I am using a property. I am owner of the property, and I am using that property for carrying out my profession. Then again, you cannot take this particular property which I am using for my profession for the purpose of computing income under this head, under house property. Now, you have an interesting scenario here. Next feature is an interesting scenario. Property held as stock in trade. Sometime back I told you that if my entire business is to let out property and receive money from that, if I'm going to do it as a business, then the rental income will be treated as income from business or profession. Now, there may be cases where there are builders, and builders might have unsold stock. What is their stock? The house property is their stock. This unsold house property, which is held as a stock in trade, right? Which is held as a stock in trade, the annual value of this property will be calculated after 2 years from the end of the financial year in which the completion certificate is being given. If the property is not let out, I will give you an example so that you will understand this. I am a builder. I am completing the construction of many buildings. Say 100 buildings I constructed. I am holding 5 buildings as my stock in trade, which is yet to be sold to people. Okay, it is still there, lying as my stock in trade. Now, the completion certificate, construction completion certificate, I am receiving it in the month of May 2020. May 2020. Okay. 1st April 20 to 31st March 21. I am not able to sell the property. I am not receiving any rent. Okay. 1st April 20 to 31st March 21. Right. Then I am not able to sell the property, or I am not able to leave it on rent in respect of this property from 1st April 21 to 31st March 22. Again, 1st April 22 to 31st March 23. Okay. Up till such period, 23, this property's annual value will be nil. If I am not let this property out, or if I am not sold it, in such, I am just having it as my stock in trade. I am not let it out, and I am not receiving any income from that. In this case, the annual value will be nil for the period of 2 years from the end of the financial year in which the construction completion certificate is received. Now, the example I gave, May 2020 is the period I am receiving the completion certificate. What is the end of the financial year in which I am receiving this certificate? The end of the financial year is March 21. I might have received in May itself, but the law wants me to take the starting point is only the end of the financial year. So, even though I received the completion certificate in May itself, or even take a case where April, on 2nd of April, I am receiving the completion certificate. Okay. In this case, what happens? So, from April, end of this financial year is 31st March 21. From that 31st March 21, for a period of 2 years, I am the annual value of the property can be taken as nil, provided I have not let out this property. It can be in the completion certificate I could have received in April 20 or May 20 or even March 20. Suppose I receive it in March 20. Okay, then again the period will be 1st April 22, 1st April 21. So March 21, and the completion certificate if I am going to receive in March 21, then the 2-year period will be 1st April 21 to 31st March 22, 1st April 22 to 31st March 23 for a period of 2 years. Please note that this is an amendment made in 2019. Previously, it was only 1 year was given. Now it is 2 year. So please note for your examination, This might be a question for 2 years. Okay, so you understood this. This is section 23, subsection 5. Now, going to composite rent. Sir, I have quite more to deal. Can I go on, sir?
Yes, you can. Carry on.
Thank you, sir.
Yes.
So, composite rent. Composite rent is what? When the building is let out along with other assets, say furniture, plant, or machinery, or the building is let out with other services like lift, security, power backup, etc. In both these cases, the rent that I receive is known as composite rent. So, the rent I receive not only in respect of the building but also in respect of other assets like furniture, fittings, plant and machinery, or the rent I receive not only in respect of the building but also in respect of various services like lift, security, and power backup. So this is a composite rent. So how this composite rent would be treated? So composite rent, whenever you have to deal with composite rent, you have to split up the sum. Okay, you have to split up the sum. How you have to split up the sum? In respect of the property, sum attributable to the property, that is the building, it will be treated as income from house property. In respect of sum attributable to the services or the other assets, it will be treated as the income from business or profession or income from other sources, as the case may be. So now, what is the manner of splitting up? So we dealt with composite rent, and when we deal with composite rent, in respect of building, whatever income you are receiving, it should be treated as house property income. In respect of other services or other assets, it will be treated as business or profession. How you split up? What is the manner of splitting up? We will see. If the let out building and other assets are inseparable, they are inseparable, together, inseparable. That is, letting of one is not possible without the letting of other. It is inseparable. Take a case of a cinema theater along with all the equipments. Okay, equipments, chairs, so many equipments would be there in a cinema theater. So in this case, the letting of the building is inseparable with respect to the letting of the other equipments. In this case, the sum receivable for the two lettings, even if it is fixed separately, still it will be dealt as income from business or income from other sources. Okay, the point I'm trying to say here is, if the building and other assets are inseparable, you cannot say that I can take only the building but I may not have the equipments. If you're not able to separately deal with it, the letting of one is inseparable from the letting of the other. In this case, the property, in this case, the income will be treated as income from business or income from other sources, as the case may be, even if the letting is fixed separately. So what does it mean? Suppose I say that for the theatre building, the rent is 5 lakh rupees per month. For the equipment, the rent is 3 lakh rupees per month. So total 8 lakhs per month. If the agreement is going to split and say, even though the rental component is split in the agreement or in the terms, yet the letting is inseparable. I can fix anything. Fan, this is the rate. Chair, this is the rate. Equipment, this is the rate. I can split and say. But the property cannot be let out separately. If that is the case, inseparable, if that is the case, then the property will not be treated as income from house property. Rather, it will be treated as income from business or other sources, as the case may be. This is one aspect. Suppose the building and assets are separable. It is separable. In this case, you have to take the building portion, income from building portion to building, and other portion, the other asset portion, you can treat it as income from business or other sources, as the case may be. Now note this. In this case, where the letting is separable, I can say, okay, I don't need the furniture. Okay, don't have to take the furniture, but you take only the house. It is still possible for me to use that. If that is the case, then I might have fixed a composite rent. I would say rent is totally 25,000, whether you take with furniture or not. I'd say it is fixed in total. Totally, I'm fixing it. Now I will have to make a split. Even though rent is fixed as a whole lump sum for both the property as well as for the building, still I have to bifurcate for the purpose of assessment. So this is the key feature. Now, in respect to property which is there abroad, house property situated outside India, so if the assessee is a resident and ordinarily resident, then the income from house property situated outside India is also taxable, whether the income is brought into India or not. But if it is a case of a non-resident or resident but not ordinarily resident, non-resident or resident but not ordinarily resident, then the property income from property situated outside India is taxable only if it is received in India. This is another concept. Now, determination of annual value. Determination of annual value, very, very important aspect. Very easy to understand, but often confused by the students. So I will ensure that you are able to understand it in an easy manner. Okay, I will do that. How you determine the annual value? Now, for determining the annual value, you have to consider the first. Let us go case by case. Okay. First case is when the property is let out throughout the previous year. From April to March, throughout the property has been let out. This is the first scenario. In this scenario, how you calculate the annual value? First, you need, for the purpose of calculating gross annual value, you have to see, you have to compare between the expected rent and actual rent received or receivable. You have to see the expected rent and compare it with the actual rent received or receivable, and whichever is higher, that will be your gross annual value. Okay, as simple as this. This is the broader structure. Expected rent versus actual rent received or receivable. You compare both, whichever is higher, you take it as gross annual value. When the property is let out for the whole year, right? Now, how to calculate this expected rent? So first you have to calculate the expected rent. How to calculate this expected rent? We need two variables for that. With this two variable, we'll compare it with the third variable. What are the two variables? You have to see the municipal value and you have to see the fair market value. Fair market value versus municipal value, whichever is higher, you have to consider this. But it is restricted to standard rent. It is restricted to standard rent. I will give you an example, you will understand it properly. Fair market value means what? Similar property in similar locality with similar services, what it can fetch. That is fair market value. Okay. In the same, it's a very big township where about 400-500 apartments are there. Similar locality, similar square feet, similar facilities, whatever the other property fetches, this property should also be expected to fetch the same rent. That is the fair value. Okay. Fair. Municipal value is municipal authorities year on year they do determination of the property. Local authorities, the municipal local authorities, they will deal with the property. They will say this is the value for this particular property. So this municipal value you compare it with fair rent. Now we will go to an example. The fair rent is 10,000 rupees. Fair rent is 10,000 rupees. Okay. Municipal value is 5,000 rupees. You compare 5,000 with 10,000. Municipal value with fair rent. Fair rent is higher, 10,000 rupees. Okay, this will be the expected rent. But now the third variable is going to come, the standard rent. Standard rent is what? Standard rent is the rent applicable as per the Rent Control Act. Rent applicable as per Rent Control Act. Okay. This Rent Control Act, as per Rent Control Act, the value of this property, the standard rent for this property is 15,000. Okay. Standard rent is what? 15,000. As per Rent Control Act, standard rent is 15,000. Fair rent is 10,000. Municipal value is 5,000. Municipal value 5,000. Fair rent is 10,000. Standard rent as per Rent Control Act is 15,000. Now you have to see the fair rent and the municipal value. You find 10,000. So you go with 10,000. Now you have to compare the standard rent and see the standard rent is higher. then you won't take the standard rent. The standard rent is higher, you won't take the standard rent. You will only compare between fair rent and municipal value and say whichever is higher, 10,000. This is the expected rent. We are in the step of calculating expected rent. Okay, this is the first thing. Take a reverse example. Municipal value 5,000, fair value 10,000, standard rent is 8,000. Standard rent is what? 8,000. Okay. Now municipal value is what? 5,000. Fair rent is what? 10,000. Higher of the two is what? 10,000. Right? Now the standard rent says it is only 8,000. If you compare municipal value and fair rent and take the higher of the two, and if the standard rent is less than this value which you have arrived at after comparing fair value and municipal value, then standard rent will be your expected rent. Got it? So standard rent is what? 8,000 rupees. So 8,000 will be your expected rent. Okay? So when you compare fair value and municipal value, you take the higher of the two. But once you take the higher of the two, you have to check with the standard rent. If the standard rent is more, you ignore that. No standard rent. I will have the higher of the two. The standard rent is less than this value. This value means what? Comparison between fair rent and municipal value. This value means fair rent versus municipal value. You compare this value with the standard rent, and if the standard rent is less than this value, then standard rent will be your expected rent. Then your standard rent will be your expected rent. This is the first step in calculating expected rent. The expected rent you have in one hand. You compare it with what? Actual rent received or receivable. Actual rent received or receivable is what? Suppose actual, in this case, take this particular case. 5,000 municipal value, 10,000 fair rent. Okay. Standard rent is 12,000. So 10,000 will be your expected rent. Suppose actual rent I receive is 11,000. Actual rent I receive is 11,000. So actual rent 11,000 versus 10,000. Whichever is higher, 11,000 is higher. Actual rent received is higher. So that will be my gross annual value. Got it? So first step is to see what is the expected rent. As I said, compare it with fair market value with the municipal value. Then you check it out with the standard rent, whether it's higher or lower. The standard rent is lower, you adopt the standard rent as expected rent. Standard rent is higher, you ignore standard rent and take only the higher of the fair market value and the municipal value, whichever is higher. That value you compare with your actual rent received or receivable. Then whichever is higher, you will be taking as gross annual value. Give me a moment, 1 moment please.
For students, for enjoying session. Monday also we're having session, 5 o'clock. From Chartered Accountant Manjuri is going to do the presentation. What is the importance of CSR committee, the expenses for the current scenario, how it is going to impact. By Chartered Accountant Manjuri from Pune, she is going to address. So make use of the time properly. Yes.
Yes, sir. Thank you.
Carry on.
Yes, sir. So this is how you will deal with. So once you have the expected rent, then you compare it with the actual. You compare it with the actual rent received or receivable. Whichever is higher, you take it as your gross annual value. From this gross annual value, you have to deduct the municipal taxes paid. I'll come to it a little later. So first, we will go step by step. First, we saw when the property is let out throughout the year, how you calculate the gross annual value. It will be higher of expected rent versus actual rent received or receivable during the year. This is the first category. Now we go to the second category. Second category is where the property is let out property is vacant for a part of the year. Let out property is vacant for the part of the year. So out of the 12 months, I have let out the property for 2 months, and 8 months it is vacant. No one was there. Okay, in the sense I wanted to let it out, but no one was willing to take the property. Still, it will be a let out property only, but it is vacant for the part of the year. In this case, how you calculate gross annual value is that it is very simple. If your actual rent received or receivable is lower than the expected rent, then the actual rent received or receivable will be your gross annual value. So that is logical, right? For 1 full year, I am having the property. Out of the 1 full year, only 2 months I have let it out. For balance 10 months, no one has come as a tenant at all. So in this case, the law is giving me some relaxation. The law is stating, okay, whatever is your actual rent or receipt or receivable, that you cannot have, provided it is lower than the expected rent. So obviously, if you calculate the municipal value, and because I said 10,000, 5,000, 12,000, you have to multiply with 12, okay, for the purpose of calculating. For simplicity, I made it for 1 month. When you multiply it to the 12, obviously expected rent will be more. So in this case itself, your actual rent would be only for 2 months, means only 11,000 into 2, 22,000. But whereas your expected rent will be much higher. So you cannot say rent received or receivable versus expected rent. Not that. It is not the case. So whenever you let out the property and the property is vacant, let out property is vacant for a part of the year, then if the actual rent is lower than your expected rent, then your actual rent can be taken as the gross annual value. Okay. In this case, you should also understand. Suppose take a case where I am having a property to be let out, but for the whole of the 12 months, no one has come. For the whole of the 12 months, no one has come as a tenant. In this case also, the actual rent received or receivable will be 0. So gross annual value will be 0 in this case, and then you proceed. Why I am telling you this, I will deal with it in a short while from now. There is a small thing to be understood, small distinction is here. So even if the property that is always let out, and I intend to let it out, if it is vacant for the whole of the year or even for a part of the year, then this is how you calculate. Say a case where for the part of the year it is vacant, then if the actual rent is lower than the expected rent, the actual rent will be your gross annual value. So this is something that you need to understand when there is vacancy. Take a case where the vacancy is not because of, I have not received the rent not because of vacancy, but because I used it for some other purpose. Say for example, 12 months is there, 2 months I have let out, 10 months, in the 10 months, 8 months no one came, but 2 months I'm using it for renovation purpose. I'm using it for renovation purpose, or I'm using it for some other purpose. In this case, this application will not, this rule will not be applied. That is, rent which is lower will not be applied. So for you to apply the rule that actual rent, if it is lower than expected rent, if you want to use only the actual rent as your gross annual value, for you to apply this, the vacancy should be there for the part of the year. Okay, this is the second case. Third case is where self-occupied property or unoccupied property. Self-occupied property is what? I am using it for my own purpose. If I am using the property for my own purpose, that is self-occupied. Unoccupied is a case where I am not using the property because I stay elsewhere for the reason of my business or profession. I stay in some other building, but that building should not belong to me. I stay in some other rented building owing to my business or profession. I'm not able to occupy this property. Suppose I have a property in Chennai. Okay, I am working in Mumbai, or I have my business in Mumbai, and I am staying in a rented premises. The property belongs to someone else, some other owner. I stay in that Mumbai property which doesn't belong to me, and this property in Chennai, I'm keeping it closed. I have not let it out to anyone. In this case, this is a case where property unoccupied for the reason of the owner being staying elsewhere for his business or profession. Okay, at a different place, and resides in a building which doesn't belong to him. Okay, in this case, the annual value will be nil. Annual value will be nil. Self-occupied property means annual value will be nil. But this annual value nil annual value in respect of self-occupied property or unoccupied property is now available for 2 properties. So I cannot say, suppose I have 5 properties. Yes. Suppose I have 5 properties. I cannot say that I am not occupying the entire, I am not using all the three properties. I am saying all the three properties are self-occupied and want to take the gross annual value as nil. That is not possible. Okay. This self-occupied property gross annual value nil is applicable in respect of only two properties. Again, this is an amendment. Please note that. Okay. Then property let out for a part of the year and self-occupied for the part of the year. So I am, in this case, it will be the expected value. So I cannot say one portion I was there as self-occupied property, another portion I have let it out. If that is the case, self-occupied for a part and let out for a part, then it will be only the expected rent. Okay. Then you have deemed let out, which means that more than two self-occupied property, if you are not occupying the property, if you are not occupying the property for more than, it is more than two self-occupied property, then everything, other properties will be deemed to be let out properties, deemed to be let out properties. Then similarly, I explained about the stock in trade property when it is held as a stock in trade. Also, I explained it to you. Suppose you have a property which a portion of it is let out and balance you are using it for your own purpose. In one single property, upstairs and downstairs, if it is that way, you have to split. You have to split and see, and value will be calculated only for that portion which is being let out. Okay. So I will just conclude it by discussing about one aspect alone. This is pertaining to the concept where income from house property is charged on notional basis. Normally, the income which you receive, that alone, that will be taxed. What you receive or what is accrued to you, that will be taxed. But when it comes to house property, even notional income is taxed. What is the case of notional income being taxed? We saw self-occupied property, more than two property, that will be annual value will be calculated. Number one. Number two, similarly, where the actual rent is less but expected rent is more, you are taking the annual value in respect of expected rent only. So this is also a case where notional income is charged. So there are there are two more sections relating to deductions and co-owned property. Deductions, if I can say in just 2 minutes, it is mainly interest can be claimed as a deduction. Ceiling of 2 lakh rupees of interest deduction can be claimed in respect of two self-occupied properties. So if you are having a self-occupied property, the interest deduction that you are claiming, this will be with respect to the ceiling will be 2 lakh rupees, and this 2 lakh you can take it for both the properties. Okay. You cannot say that for one property 2 lakh, another property 2 lakh. So this is an amendment. This 2 lakh ceiling is an amendment. So previously it was 1.5 lakhs. Now it has become 2 lakhs. It is an amendment. So this 2 lakhs will be your ceiling for claiming deduction as interest in respect of self-occupied property. In respect of let-out property, there is no ceiling. There is no ceiling with respect to the interest component. Even if it is 5 lakhs or 10 lakhs, you can claim it as a deduction. But only catch is that when you are carrying it forward, you are allowed to carry forward only to the extent of 2 lakhs. Of course, that will be dealt in your set off and carry forward chapter. Just a hint I'm giving. So interest deduction you can claim. Then 30% standard deduction you can claim from your net annual value. Gross annual, that is your net annual value. Gross annual value, then 30% of gross annual value is there, then 30% of net annual value, that is allowed as a deduction. What is this net annual value? So gross annual value less municipal taxes paid. Whatever municipal tax you pay from your gross, I told you the methods for gross annual value. You deduct it from municipal, you deduct the municipal taxes from that. What you get is net annual value. 30% of it, you can claim it as a standard deduction. Standard deduction is rent and interest. These are the two aspects. And co-owner property, again, each person can have the entire share. That is, each person can claim 2 lakh rupees as interest and deduction. That is with respect to co-owner property. If the shares are separate, it will be deduction should be allowed given to each person separately. If the shares are indefinite, it will be treated as an AOP, Association of Persons. So these are the basic things that I wanted to share. I hope the session was useful. Maybe some other time we will have a quite a detailed session. So I've exceeded my limit more than what was told to me. So thank you very much for this wonderful opportunity. Thank you so much. Thank you, students, and thank you, sir. Thank you.
Good, Kanam. Wonderful session, Kanam. God bless you.
Thank you.
Students, Monday evening, 5 o'clock, again we can meet with another session. Thank you all.
Thank you, sir.
Bye-bye.
Thank you. Thank you.